here, live, in the flesh, in Menlo Park, California. It's that time of year again. In beautiful Sand Hill Road, Sharon Heights. The air is crisp. The weather is not too cool, but it's nice. The air is moist. And how are you today?
I'm great. I'm looking forward to speaking right back here in a couple hours. So we're here at Sharon Heights Country Club. Have a lot of history here, played a lot of golf rounds here.
Yep. A lot of middle school events, golf tournaments, bar mitzvahs, sweet 16s, the whole nine have actually in fact occurred here. Now, an extra little legacy piece is the Lone Star Capital's second holiday party here.
Yeah, so let me tell you a funny story, because a couple years ago, Dosh and I hosted a investor dinner here in the Bay Area, because obviously you're from here, Dosh and I grew up here, and so when we started Lone Star, a lot of our early investors were here. And to this day, Silicon Valley arguably is home to the most of many of our investors.
Yeah.
And probably the largest concentration.
I would argue the best
Also the
investors.
best investors.
Yes.
Heavy hitters.
You know
right?
you are. Shout out and thank you.
Not just many investors numbers wise, but also many quality investors and all that good stuff. So it's a pleasure to be able to come back here, not just because it's where we grew up and it's a good time to come home and see everyone for the holidays, but it's also a great time to come back and connect with our investors. And so a couple years ago, Dosh and I hosted an investor dinner in Palo Alto at a restaurant. We had it wasn't even a private room, it was low key. We invited.
That was before we got into the private room side of things.
Yeah, exactly.
The market's treated us so well.
It was earlier days, but
yeah.
Here's the funny thing though, is Dosh and I, we thought, well, we want to have an intimate gathering with our top investors. So we only invited 6, 7, 8 investors. And it was this small table, it was Dosh and I, and it was very intimate and small, right? And then, so we could have had a bigger event, but we chose to do that small intimate dinner because we wanted to really connect with our top investors. However, then the following year, we did Sharon Heights, last year's event, but we did it in another room, not this big room. This room here, you've got all these seats, then we've got all these tables over here. It's a full production. I mean, we're spending tens of thousands on this, believe it or not. But last year we did Sharon, this venue, but it wasn't as amped up as this. But the same investors that went to that small intimate dinner, they went, wow, we didn't realize that you had this many investors. We didn't realize what a successful company you were. So it's just a funny realization that in our minds, we thought, well, we want to really
give them a better experience.
Yeah, exactly. We want to give them that one-on-one time.
Yeah.
But in reality, they actually enjoyed so much seeing the hoopla and seeing a big crowd, and it just shows you the power of social capital, the power of social proof, right? If people walk into a room and they see, look at all these investors of Lone Star, they're more likely to become an investor of Lone Star.
Right. And speaking of investors of Lone Star, speaking of our network being grassroots, in the manner and kind of the thought of that, I really want to talk about today. We're going to have your whole presentation clipped after this, so this episode will look long, but in actuality, it's not going to be very long for what we're doing here. In about, T-minus 45 minutes, we're going to have these gates flooded with great people, investors, and like-minded people, inner doors to mingle and, share the holiday season. But you'll do your presentation, but what I want to talk about today is something so important, which is our referral reward program, which we just cooked up. So without further ado, let's get into this. And if you're home right now, if you're an investor, if you're a capital raiser listening to this, this is a way to kind of incorporate you into what we're doing and also help you out and reward you. So can you please get into this new system and program rewarded on a moving forward basis?
Yeah, it's a wonderful topic, and we've in the past have done referral gifts. If an investor referred a family member or friend to invest with us, we would send them a charcuterie board or just some other gift or something like that. So we've done referral gifts in the past, but we really, in the holiday spirit and in being back in the Bay Area with all our wonderful investors, we got our creative juices flowing, and you were thinking, why don't we really amp up our referral program and really reward people for giving us a vote of confidence and recommending us to their family and friends. And so that's exactly what we've done. So we've now rolled out our new referral program where if an investor refers another investor, they get a $2,000 cash bonus. That can be as cash, that can be as part of equity in a given deal.
At close.
At close.
So it's not, hey, here's my friend Peter, And oh, for the introduction, you get $2,000. This is, hey, if you're in front of Peter, funds and invest on a deal that we close, then in fact you'd be in receipt of that $2,000 bonus. Is that correct?
Right. So, yeah, it's a really generous referral, but we understand that our investors are wealthy individuals. Their time is incredibly valuable, so they're not looking to run around and hand out referrals and stuff. So they need that little extra motivation. Everyone loves getting a little bonus. So we think that that is a no-brainer for us to do, and it's a win-win because why wouldn't we want to incentivize our top investors to go and refer people that are like them? We already know that we like them, so how do we find more people like them to continue to grow the business in the way that we want?
And just for perspective too, we've kind of done the research, kind of gone through our own data. We're only going to keep leveling up that as you're going to Hermosi's event, which is super exciting in January. We can touch on that later. But we are always the biggest capital partner in our deals, meaning that in our capital stack, when we raise it, obviously debt's the largest piece, but of the equity, which is all common equity, in every single deal that we've done, particularly this year, who's been the biggest partner? It's been ourselves. So how do we supercharge that and level it up? How do we, kind of control and have more quality deals and keep buying the right type of opportunities through every single part of the market cycle? It's us being the biggest player in each deal. It's us working with our internal clients and in doing that. So this hopefully is a way to organically grow our business with the help of you guys with this nice bonus program. We're hoping that this is a way to incentivize you, but also show what we're looking to do long term, which is basically be the biggest player in every single deal that we're in, maintain control, maintain autonomy, and keep delivering great results. But that can't be done without the help of our friends and family and getting that organic growth via referral. But there's more. So let's talk about the next iteration of this. So there's the just referring a typical LP investor into a syndication.
Right, and of course it doesn't matter how much this invests. If you refer a friend and they invest, it doesn't matter whether they invest $50K, which is our minimum, or $500K.
Yeah.
You're going to get the same fee regardless. So, just to clear up any confusion.
Exactly. We got to be compliant here. But let's talk about the next thing, which is the 1031 exchange. So Dasha over there is the biggest 1031 exchange expert, lover. I even love it more because I don't have to worry about anything, all the intricate back workings.
Makes it very smooth.
Yeah, the intricate back workings, which is a lot of moving parts. You will know this as the 1031 exchanger. And if you're Kent or Dasha working on the back ends there to make this all queued up for you so you don't have to pay those taxes, we can defer those gains and whatnot. But let's talk about what's in it for someone to refer us a 1031 exchange investor. What does that minimum look like? How does it work working with Lone Star Capital 1031 exchanges? And of course, what's in it for me? What's in it for the person who refers that 1031 exchange investor?
Yeah, so for those that don't know, you can actually sell an investment property and 1031 exchange it into a syndication style deal with us as the sponsor. So this is a great option for someone who is essentially a tired landlord. They might own a vacation property, they might own a rental property, an investment property, and they want to sell it because they have a lot of equity there, but they also have a lot of taxes that they would pay in capital gains if they were to sell. So the 1031 exchange is a fabulous vehicle where they can actually sell the property, roll those gains over tax deferred into a new opportunity. And even better, that new opportunity can be with Lone Star. So they can go from an active owner of the real estate to a more passive owner because Lone Star will be obviously implementing our professional management and oversight via property management, construction management, asset management. So this has been incredibly popular. We've had many investors do this. It's a great way for us to raise a lot of capital because 1031s by nature are bigger checks. You're talking about people selling commercial property that's worth
millions plus.
$2 million, $5 million, $10 million. So our minimum investment from a 1031 exchange perspective is $1 million. And for the referral program, we are incentivizing or rewarding people to refer a friend that has a 1031 exchange $10,000.
Oh my gosh. So funny enough, I thought it was going to be $5,000, but you heard it here live on air, so to speak, that you are willing to pay $10,000. We are, as a team, Lone Star Capital, will pay anyone who refers us 1031 exchange investor $10,000 in the event they 1031 exchange. You refer us to them, they 1031 exchange into our offering. If you can get us an investor that 1031 exchanges into our offering and we close that deal, we will pay you $10,000. That's incredible.
It's wonderful, and 1031 exchange investors are great, like we talked about, because they are a big source of capital. We've raised tens of millions of dollars through 1031s, and just like a regular investor, we hope to under promise and over deliver and provide such a great experience for our 50K investors and our $5 million investors, so that no matter who you are, you choose to keep your dollars with us. And that way, when we sell that property and we actually have a deal level 1031 exchange, those investors are excited to roll with us. And so we're willing to refer people because we know long term how valuable this business is going to be, and grow as we scale and continue to deliver for investors. So that's a big piece, 1031 exchanges. And then finally, to round out our referral program, we also are incentivizing people to introduce us fund managers. So if you are a fund manager and you have, or if you're an individual who knows of a fund manager that we aren't already in contact with, and you refer us and they raise capital for us for a deal, they form a fund to fund, the minimum to do so is, generally speaking, $1 million. But reach out to us if you want to hear about any exceptions or any particular deals in particular.
We can make them for those we like, and we like those who call us. So for the record, for those who have a phone call with us, maybe, don't tell him I said this, don't listen to earmuffs, but maybe, if you're just shy of that $1 million mark on the 1031 exchange, perhaps on the right opportunity, we can make an accommodation in certain circumstances, of course.
Every deal is unique, as they say.
Yes, exactly. So, never say never.
Yeah, so for fund manager referrals,
that we're not in contact with, for the record.
Yeah.
You can't introduce us to people that we already know and do it that way.
Or someone we've already obviously know or done business with, and also you can't get double referrals, etc. All the fine print, which we'll have in the referral program.
And email me for that. Email me, Craig, Craig, at lscre.com. You know the email, but once more, Craig at lscre.com, and I will happily provide you some literature to help on this.
Right, and so the referral fee for a fund to fund or a fund manager is $5,000, and that's a one-time fee for the introduction, and it's paid upon closing.
Yeah, so let's just talk about these stipulations once more. If you are, and just go through this so it's very clear here because it's so important, we're looking to grow our business with people like you, those who listen to the show, those who are in our ecosystem.
It's no joke.
Network.
We don't have, sorry to interrupt you, but we don't have thousands of viewers on this show.
No, we have hundreds.
We have hundreds.
But
barely, we barely have hundreds.
Right.
And so when Craig says, we want more investors like you, it's actually true. It's not just sort of we're like throwing this message out into the world. Like, this is for you, and this is for people like you.
For you, by you, FUBU.
We want more. Yeah, very good. Yeah. We want more people that we like to grow our business with, and that's why we're doing this.
Exactly. So once more, if you are a LP, a limited partner, a passive investor, and you're looking to refer your friends who are passive investors, or let's say you've never even invested before, like you're newer to real estate, you know someone that's got some money that would benefit from the services and the deals that we're providing. You know someone who's looking to invest, someone who's looking to supercharge their investment growth and whatnot. Please, we are looking upon you to help us grow, and we want to compensate you along the way. So if we have no contact with a LP, a passive investor looking to work with us, we have no contact with them, on a one-time payment for that referral, we'll pay $2,000. There's not a tail, there's not a $2,000 fee in perpetuity. This is a $2,000 fee.
It's not an investment bank deal.
Exactly. There's no royalty on this. This is not Shark Tank, unfortunately. But a $2,000 fee for an LP partner. Similarly, for that introduction for a big 1031 exchange investors, we alluded to that $1 million mark. Maybe an exception for a little bit lower if I get him in a good mood. $10,000, and then once more, $5,000 for any fund manager. So like if you're probably more of a capital raiser here, someone who's maybe looking to find perhaps someone in the business, will pay $5,000 if and when at the time that they fund and close on a deal with us. So that is the exciting rollout we have here. We're hoping this really supercharges our base, gets everyone going, gets excited to sing the Lone Star Gospel. We want to pay this out to you. So this is something that we're super excited about. The best way to grow a business is organically, through word of mouth, through referrals, by doing the right work, and we're going to do just that.
Love it.
Yeah. So that said, I would be remiss if we didn't talk about what happened today, which it is December 18th for those who don't know, and there was a 25 basis point rate cut. So that was a piece of news there. What do you know? The Treasury market is skyrocketing right now. So if you hadn't rate locked, you are screwed. Thank God we flipped over our debt structure to a floating rate structure for our most recent acquisition, which may or may not have a little bit of room in it.
Yeah, why don't you let people know if they are interested in investing?
Yeah, we have a touch of space left if you're looking for some end of year tax needs.
This is not a public solicitation.
No.
Please reach out privately to Craig if you're interested in learning more about this deal that we have closing. It is a year-end close, so if you have year-end depreciation needs, if you'd like one more great multifamily deal to invest in before the end of the year.
This, in fact, is that. Yes. So we had a 25 basis point rate cut. And then the other news and tidbit there was that they announced that they'll be cutting rates again, but only twice in 2025, which I don't know how they can forecast that or predict that because, information is fluid. But I guess it's a forecast. At the end of the day, these are projections, right? What do you make about the rate cut today, and what do you make about the Treasuries going up and the foreshadowing of a 2-cut next year?
Yeah,
Three
sure.
parts.
Yeah, so to put it all together, everyone knew that the Fed was going to cut rates today. It was baked in 100%. I mean, almost 100%, right? The market had basically a 98% odds of a rate cut today. So the Fed cut rates, just as the market predicted, right? So there was no real shock to the system with that news. However, the meeting notes and Fed and Jay Powell's speech, the chairman of the Fed, was hawkish. Basically, they cited that they see inflation being a bit stickier than previously thought, and they increased their forecast of inflation core PCE for 2025 from 2.1 to 2.5. So that is an upward adjustment to their inflation expectations for 25, which basically means, hey, we think inflation is going to be a little bit stickier, so we're going to be a little bit slower to cut. They also feel like the labor market is pretty sound, which, me, I'm like a broken record. I'm saying, hey, the labor market is weak, the labor market is weak. And eventually I'll be right? I'll predict
like a broken clock.
Exactly right. I'll predict the last 9 of the 7 recessions or whatever, how it goes.
Right.
But that's that kind of took the market by shock, right? The cut wasn't shocking, but the fact that they increased their inflation expectations and then decreased their cut expectations, they went from, we think we're going to cut 4 times next year to twice. That's a huge difference, and that's got the stock market on edge. That's got the bond market on edge. So bonds sold off heavy today, and stocks sold off 3% today. So that's they're puking all over this news, and I think it's a bit of an overreaction. It's an overreaction by the Fed, and it's an overreaction by the market. But it's not really the market's fault for taking the Fed seriously, right? You got to take the Fed seriously. But I do think that the Fed is kind of looking at near-term inflation data and thinking, oh wow, this is a bit scary, because I do think that inflation will come down faster than expectation, and the labor market is weak. I know I sound like a broken record, and you saw in our friend group chat, Francis asked how many rate cuts in 25, and I think there's going to be 150 basis points. So
then the real question is, to me, is not about rate cuts, because rate cuts aren't really correlated to, I guess, mortgage rates going down. Rate cuts
not
aren't
in the short
correlated.
term, absolutely.
Exactly, not in the short term.
Yeah.
I'm seeing mortgage rates now for, a conventional mortgage about 7.3%. I'm saying, if you were to rate lock a deal right now, if you're a commercial buyer or borrowing, somewhere between 5 to 10 year debt, that's looking at mid 6.5 to 7%. I mean,
it's too high, but yeah. I mean,
in that, it's 6.5% then roughly.
Yeah, exactly. You're looking at a 450 Treasury. You're looking at the high end of spreads being around 200 basis points. You're looking at 6.5.
Yeah.
So it's like low to mid 6s.
But there's a lot of deals that got pulled off the market for this reason recently. There's very slow trades.
That's because deals are only trading in like the 4s and the 5 caps.
Mm-hmm.
So basically, there's not a single deal out there that's positively levered today. So it's very, very difficult to transact on a fixed rate basis. The only people really buying real estate today are people who are comfortable with floating.
And people in this room, because it's us, because there's very few.
Yeah, exactly. Yeah, I think people will turn out to look very smart buying in 2024. It's been a bumpy ride, but we've done very well, and other people who have bought this year will do very well as well.
Any other predictions?
Well, it'll be really interesting to see when we're sitting here next year when I predict 6 rate cuts in 24 to see if I'm right.
Well, we're also going to have a prediction episode here coming up, I think, pretty promptly. Should we save that for everyone on J6?
I don't think you're allowed to say that.
Well, no, it's J6 the Monday on the first Monday of the year, really.
Yeah.
Are you insinuating something else?
No, we'll absolutely have a prediction episode. We're going to have this episode.
We're going to do a year in review. I think year in review should come next week. Mm-hmm. And then we're going to do a prediction episode the following week. We'll also do a deal deep dive and what we just did and close, I think.
We're going to have to review the annual letter.
Yes.
Year-end thing.
Yes. So, all that said, we hope you enjoyed this. Very quick, very brief, but enjoy the show and the conversation, or your presentation, I should say, coming up here. This room will be full and about right now.
All right, well, without further ado, I just want to give a big welcome and thank you
Thanks to everyone who came. We really, really appreciate all of you making it out during your busy holiday schedules. Myself, I'm from the Bay Area. Dasha, my sister, she's obviously from the Bay Area. Craig, Brad, my parents, right? These are the key components of the Lone Star team, and we're all from this area, and so it takes a village, and we wouldn't be where we are today if it weren't for the people in this room. Some of our most loyal investors, some of our best investors are from the Bay Area, so we love coming back here every year. So just want to say welcome and thank you. So to kick things off, I've got a chart all ready for you, fun presentation. So I want to give a market dynamics recap of 2024. So it might not be the most descriptive chart here, but this is it's been a very volatile last few years. And this is the 10-year US Treasury yield. And so you can see these bumps along the way, this dip, the spike, dip, spike, dip. This is a very difficult environment to make sense of deals, to transact, to have confidence, right? You need to know the future. You need to feel like you know the future in order to be able to transact. So the last couple of years have been bumpy, to say the least. And real estate obviously heavily depends on treasury yields in order to finance property, and real estate's a levered instrument, so you need to rely on accretive debt in order to be able to create good investments. And so we're very fortunate at Lone Star that I think the four deals that we have rate locked this year just so happen to be here and here. So we got very lucky. That's a really good year for us. But to recap it, in 2023, the market had substantially changed from 2022. We saw cap rates expand, rates go up, and investor sentiment shift dramatically to a much more cautious sentiment, bearish, fearful. So it was harder to raise capital. A lot of investors were scared, and for good reason. It was a very uncertain time, and there weren't that many transactions happening, so people didn't really have a sense of what was going on. Then in 2024, this year, we started to see some things happen. We started to see cap rates come up to a point where it was a very attractive entry point on some deals where we actually bought, for example, Portland Copperleaf, purchased that property at over a 6 cap, and that's a 2003 nearly Class A high growth suburban asset. At a 6 cap, you just haven't seen that for many, many years. So I don't think, some of the buys that we've been able to do in 2024, I don't think we'll be able to recreate for quite some time. And again, you can identify good deals all you want, but if you don't have the capabilities to actually put the debt and the equity together, then you don't have a transaction. So you don't have the ability to even pursue some of these great opportunities without strong investors like many of yourselves in this room. So that's kind of the highlight of 2024 is it's still a very difficult time to raise money. It's not like money's abundant and it's like high flying days. It's a tough time, but for the right deals with the right investors, it's absolutely possible, and there are good deals. And so we're very proud of the knock on wood. There's a lot of wood in this room, but knock on wood, we're closing on Portland to Sky, our 5th deal of the year on Friday, and that will cap off a very successful year where we've acquired nearly $200 million in assets in 2024. So I kind of talked about a lot of this, but to dive in a bit deeper, I think this is very interesting because when the market was going up and up and peaking from 2020, 21, and into 22, a lot of asset prices converged. Basically, cap rates were low for Class A, cap rates were low for Class B, and they were low for Class C. There wasn't a differentiation there. And so when the tide goes out and when cap rates expand and basically prices come down, there's actually, you see a dispersion of cap rates, and that's exactly what we've seen. We've seen that for newer assets, for higher quality deals in better locations, those cap rates are very tight, especially when you consider where rates are today, and there's strong competition for those assets. So if you were to put a property up for sale of that caliber, you would see a lot of bids, and therefore you would see a pretty attractive price, all things considered. Then you contrast that with older assets, 1980s, 1970s assets, perhaps in worse locations. There's very few deals that are getting done in that space because what sellers are willing to sell for is not in line with what buyers are willing to pay, and so there's just very little activity there, and it's it's very tough. I mean, we own a lot of this product. We own 1980s deals. We are not afraid to roll up our sleeves and work with, difficult areas, difficult tenants, difficult properties. But we just haven't seen many opportunities this year where those assets have priced low enough to make it an attractive business plan to actually go in there and do that work. And a big part of that is where lenders' bases are on these deals, because lenders lent on these properties back in 2020 and 2021 at very high loan amounts. So a lot of these deals are actually worth less than what the lender's paper is on the deal. And this creates a roadblock between potential buyers and sellers because you actually now have a lender in the middle. And so it's up to the lender to actually make a deal happen, either through a foreclosure or through a discounted payoff. And so these things take a lot of time. Foreclosures don't happen in a day, distress doesn't happen in a day. So these are not fun topics, but those are the things that have yet to create the opportunity in that space, but most likely will create that opportunity in the next year or so, which is what we're obviously keeping our eye on. We've been very fortunate to be focused on kind of newer assets with a unique strategy of affordable housing and property tax exemptions, which I'll talk about a little bit more because it's very unique to us and something that has taken us years to develop the expertise in, and now Lone Star and its investors have benefited tremendously from these unique opportunities. Just to put a bow on this, our two most focused, where we focus the most markets are Dallas-Fort Worth and Houston, and as of today, basically, cap rates are anywhere from 4.25% to 5.5% between these markets. And there's about a 50 to 75 basis point spread between Dallas and Houston, cap rates being lower in Dallas because the investor world perceives Dallas to be higher growth, to be lower risk, so people are willing to pay a higher price or lower cap rate for Dallas. But these cap rates, these aren't bargains. The market is competitive for the right assets. For these well-located properties that are less than 30 years old, you're talking about today was an ugly day for the Treasury markets, 4.5% 10-year today. These are very low cap rates in an environment like this, just making it even more difficult to transact, but it's weeding out a lot of our buyer competition. So as we're able to continue to buy assets in this environment, there's less and less competition, allowing us to buy at more attractive prices. So it's kind of, cap rates are low, but we still feel like it's a good time to buy. Assets are below replacement costs. It's a complicated game, but it's been a fun year. So like I said, with negative leverage, you're talking about fixed borrowing costs in the 5% to even the low 6%, even in the mid 6% range today, as of today, because rates moved up 10 basis points today. So with that being said, one of the few ways to transact today is with floating rate debt, which is really crazy to say because if you were to talk about floating rate debt a year ago or 2 years ago, people would shriek in terror and run away from you, right? Because a lot of people have seen bad results with floating rate loans over the last few years. But of course, you can't let recency bias hurt you. You have to be able to not be emotional and look forward. And that's exactly what we're doing because we're seeing the Fed cut rates today. And so we're seeing that the Fed will likely continue to cut and continue on its easing cycle. And if we float today, we'll have the opportunity to actually float to a lower rate rather than fixing at what today feels like potentially a high. So it's not easy to get these deals done, but it's like I said, it weeds out a lot of the buyer pool because so many people right now are shying away from floating rate loans and trying to stick to fixed, but many deals don't really work with fixed rates today. So something I forgot to mention is why are cap rates 4.25% to 5.5% today, right? I thought we are about to go into a recession or had a recession or prices went down. Why are cap rates so low? Well, the reason is because buyers are very optimistic about the future. People who invest in multifamily, particularly in Texas, are already forecasting very strong rent growth in 2026 and 2027 because they're looking beyond this year and next year where there's been a lot of supply. Because when rates were very low, it was very easy and cheap for developers to buy land and start to develop a lot of apartments. And so all those developments that started in 2020 when money was free got delivered in 22, in 23, and 24, and now rents have been flat across the market, as even though we have a lot of demand, we have a lot of population growth, rents have been flat because there's been so many new apartments being delivered to the market. But now that rates have been high for a few years, there hasn't been many new shovels going into the ground. So there really isn't a lot of development activity that has been happening over the last couple of years. So there's very few anticipated deliveries coming our way in, for sure, 26. Houston is a bit of a unique situation where even in 2025, there's very little supply coming in Houston. So we anticipate very strong rent growth in Houston, followed by strong rent growth in Dallas coming in 26. Obviously, we don't invest based on predicting the future. We look at the deal that's in front of us, and we look at the metrics in front of us, and if the numbers make sense today, we believe they'll make sense tomorrow. But that's just an explanation as to why the market is optimistic in spite of what's happening today. So people are looking out and thinking, wow, we're gonna be able to raise rents 5% per year, 6% per year in potentially 25 and 26, 27. So this chart gives you a really good picture into the supply situation. So we had record high apartment deliveries in 2024, and this has caused rents to be flat negative. Even though demand has been positive, demand every single quarter, right? It's the old cliche, everyone always needs a roof over their head, right? So there's always positive demand for multifamily, but developers can outbuild that demand. And that's exactly what we saw here over the last handful of quarters. You can see this is a chart that shows the number of starts relative to completions, right? And so starts trail completions right now tremendously, where a whole ton of product is being delivered, but nothing new is being started. So there's 218,000 more units completed than started in 2024. So this, as you can see, is a bigger supply imbalance or shortage, if you will, than even 2008. And we have a much bigger population and a much bigger demand for workforce housing than we did back then. So the anticipated rebound as far as demand and lack of supply is projected to be quite nice. So you can see the last time we had a similar boom in development of apartments and bust was over here in the early 70s. So it's always exciting to see our markets at the top of the chart. But Houston, we always feel like doesn't get the love that it deserves because it's the fourth biggest market in the country, but it's overlooked by its peers like Dallas and Austin being in Texas, and even Phoenix. But you can see the population growth is outstanding for Houston, Phoenix, Dallas, and not only is it fantastic on an absolute basis, on a percentage basis, it's incredibly compelling as well. So, and that's something that we look for. You know, we're not looking for hot markets where it's a small market but it's booming. We're looking for blue chip, biggest cities in the country that we can invest in for a very long time, that we can own thousands and thousands of units and really build scale where we can build operational expertise. And Houston is a market that we are very heavily invested in. Dallas, we own a couple properties. And a little sneak peek for what's coming in 2025 and 2026, we're looking to expand out to Phoenix, hopefully in the next year. Okay, so I want to go a little bit more in depth into our acquisitions. So this year, like I mentioned, we acquired 190 million across about 1,400 units, 5 assets. Again, knock on wood because we haven't closed on Cortland Vizcaya yet, closing on Friday. We do have a little bit of space still available in that deal, so go find Craig if you want to, sign a little subscription agreement in the back of the room. So we'll kind of flip through some of the deals we acquired this year, but a big theme of the year is the fact that we've emerged as a leader in Texas affordable housing partnerships. 4 of the 5 deals we acquired this year had some form of affordable housing component with a property tax exemption. And the 3 properties we acquired in Houston, Preserve at Copperleaf, Lakes at 610, and hopefully Cortland Vizcaya, those are all in partnership with the Houston Housing Authority, which this will be our 12th deal with the Houston Housing Authority. We're one of the main players in Houston for this strategy and structure. And this has allowed us to create very unique deals where we're able to buy newer, high quality assets But instead of relying upon increasing rents or doing value add, we're actually able to restrict the rents and lower the rents while still targeting to achieve similar value add level returns. So this is something that we have to explain to people a lot. We talk about this a lot. But then once it clicks for somebody, it's a big aha and they love it. So our repeat investor percentage is through the roof on these affordable housing deals because once an investor understands it, they love it and they know that there's not really many other places where they can get this type of exposure where they're taking very little operational risk because we're not ripping out kitchens and doing renovations and trying to raise rents $200. We're keeping rents stable and lowering them, but we're still getting an outsized return by way of reducing our expenses through the property tax exemption. So, and let's not forget to mention the fact that affordable housing is one of the country's biggest problems. And if we can play our small role and do our small part in helping fix that problem, it really means a lot to us. You know, it's great that we're doing something that's a little bit different and that we can do well by doing good. So it's very unique. It's a great thing. And then one thing I'll jump to is, Not sure why this isn't working for me.
Still not working?
It's just, yeah, thank you. So just as an example, this is my co-founder Kent and I we were at the Houston Housing Authority compliance briefing luncheon, and this is the president and CEO of the Houston Housing Authority, David Northern. So it's interesting and exciting that we get to be not just a part of these partnerships and do these deals, but we actually get to help influence policy and we get to help actually craft these deal structures with our public counterparts.
Can I go back to deals?
No, it's okay, we'll keep going. So another very exciting part about 2024, arguably the most exciting part about 2024 is not just the portfolio growth, but really the team growth. And we've had some big changes at the property level, at the corporate level, and it's been a very big year. So big thing for me was in May, I made the temporary move down to Houston. So I spent 5 months living at one of our properties. And during my stint, I was traveling property to property, shadowing every on-site team, all different positions, and really got to learn the ins and outs of our operating portfolio so that we're preparing ourselves and building the right foundation for the scale that we have and the scale that we want to have in the future. So with that, we brought on 2 additional asset managers. Obviously, as the portfolio grows, we need to continue to make sure that we have the proper oversight, management, and attention. And we also brought in some unique ways to improve our operations as well. One being my favorite is culture index. So this is a very unique way to vet potential employees and to retain them and to promote them. And so this has been a game changer for us as we've gone on a big hiring spree and we've been qualifying talent and things like that. So just having a leg up and a way to kind of cut through the noise has been a game changer and something very exciting just to learn about the way people work, the way people think. And that's something that I didn't know this, but I was very passionate about seeing kind of how there's no one perfect personality. You know, everyone's personality is suited well to a different position, and it's all about defining what a certain role at your property, whether a leasing agent with a smile, or a maintenance person who's very stable and deliberate, or a manager with a good leadership capability. You know, it's very cool to build the right team now that we have over 100 employees. So we had a very big problem this year as well. We realized that we were growing to the point where we needed a chief operating officer. And we needed to bring in somebody with a lot of experience. We needed to bring in somebody with the proper accounting skills to be able to take our accounting department to the next level. And most importantly, we needed somebody that loves me unconditionally. So that, of course, was none other than Beardsley, my mom. So we now work side by side together. She brings 20 plus years of real estate experience. She has over 6 years of experience directly overseeing her $20 million personal portfolio of properties. And she's brought over some key personnel from her management team to our company. So it's almost been like a mini merger where we're bringing the best of the best together and bringing some of her kind of, if you will, small scale, small landlord tactics with kind of the more larger portfolio, larger corporate system. So it's a perfect blend where it's like we're starting to become a big company, but we're doing our best to stay small, stay nimble, and stay very active and very hands-on. Another very exciting thing, which is in line with the growth that we've seen, is promoting Hannah Wyatt, who was our executive assistant, to director of human resources. So she's been crushing it, helping us scale, helping us make sure that we're doing so legally, not getting sued by everyone. And she's just a perfect fit for the job. So that's another way that we're kind of preparing for the future by redefining our employee handbook and our rules and procedures and all the things that I don't want to think anything about, and I'm sure many of you don't want to think about or hear about from me anymore. Can you go to the next slide? Okay, so here's some lovely pictures of some of our new key team members. And then I already spilled the beans on this, but in May, came down to Houston as CEO to run operations. I've been able to focus 90% of my time this year on operations, leaving acquisitions to Brad Oliver, who, shout out to Brad. His family is the reason why we're able to enjoy this wonderful space, so we're very grateful for that. And also Craig, McGrouther, and Dasha, my sister, have been handling the investor relations side of the business, so I'm sure many of you have been speaking in depth with both of them. And they've been making things run very smoothly while I've been focusing on putting sticky notes with collections on my forehead as we kind of drill into our managers, hey, you need to collect that rent. And here's me answering the phone at a property, which is a fun thing that I never thought I would be doing, but picking up the phone and saying, hello, this is Broadstone Apartments, how may I help you? So, like I mentioned, just to top it off, we've made operations the true focus of 2024. The accounting and reporting process has seen a ton of improvement. We've been able to clean up that process, streamline it. We're getting distributions out earlier. We are getting those communications out, finishing up the accounting reports earlier in the month rather than later. Something that has been super exciting is we have put together this new on-site team bonus program. And this is very revolutionary. The industry has these old styles of bonuses and it's hard to get people motivated. And so we came up with this innovative paid up unit bonus program where it aligns the entire on-site team to want to pursue one thing and one thing only, to maximize the number of occupied units with no rent owed. And so this sounds very simple, but it's a novel theory in multifamily management, because the typical bonus program gives people a bonus based on a signed new lease. But is that a quality tenant, or are they here today, gone tomorrow? Or they pay a bonus for occupancy. But again, is that high quality occupancy or low quality occupancy? And with maintenance guys, are they even getting a bonus at all? So we're including the maintenance team in these bonuses because we want to, and anytime I talk to a maintenance person, I make sure they understand a renewal is the most important thing to us. There's no bigger vote of confidence from a tenant than if they choose to stay with us and renew their lease. And the number one reason why a tenant leaves us is maintenance issues. So our maintenance team is actually the number one reason why we'd be lucky enough to get our most important thing from a tenant, which is a renewal. So I tell them, hey, if we want to maximize this PUU, the number of paid up units, and you get a bonus based on this, then all of our interests are aligned here. The manager's interests are aligned, my interests are aligned, your interests are aligned, the maintenance person's interests are aligned, all to get maximize this number. And it's very simple too. So there's a little bit more to it that we've added to really make it work as best as possible, but we've seen great improvements already after having implemented this for about 4 months or so. Some other boring things, I'm going to rip through this, are expense audits. We've been doing a ton of insourcing and bringing different things in-house like pest control, like valet trash, drawing a blank, but there's a lot of things that can be outsourced, but by bringing it in-house, you have more control over it and you have more cost control as well. Here I have landscaping, due diligence, maintenance tasks. So, by the way, I actually wrote all this in my forthcoming annual letter, so I very much look forward to sharing with you all that, and you can get my full thoughts there, which I think you'll find interesting too. So, to wrap it up, the 2025 vision. Our goal is to acquire $250 million in assets with a focus on quality over quantity. We want to acquire about 5 to 6 properties, and we're looking to do so majority in Texas. If we're lucky and we are successful early enough, we can perhaps even see an acquisition in Phoenix, but we're going to take our time a lot when it comes to expanding into a new market because we're going to be an outsider coming in. We have a lot to learn. We're going to be patient, and we're going to be humble, and we're not in any rush. Phoenix is going to be here forever, and we can continue to be successful in Texas. So, but with that, we do want to hit this ambitious target of $250 million. Operational excellence, we want to continue on the success that we built in 2024 as far as improving our team, improving our management, our operations, and all metrics across the board. And our commitment to investors remains a focus on transparency and, of course, improving returns while reducing risk. So really, the big capstone is become an operating company that does acquisitions, not the other way around, right? If you think about that, play that the opposite way, it's not such a pretty picture. Okay, wonderful. So many of you are already longtime investors with Lone Star. Some of you are newer to the company, but we just want to emphasize the few ways that you can partner with us in 2025. So obviously, we continue to be open to LP investments, Class A, B. We'll be rolling out some new investor classes as well next year in 2025, which is very exciting. In addition to that, some of you are familiar with our 1031 exchange program. Dasha is an expert in handling these 1031 exchanges. These are complex transactions, but we make them smooth for you. So if you own an investment property, a commercial property, and you want to actually sell that, defer the capital gains, and transition into a more passive form of ownership, you will still own the property directly in accordance with the rules of a 1031 exchange, but you will now be able to enjoy the professional oversight of Lone Star Capital handling that investment. So that's a really big win. We've actually done tens of millions, over probably $40 million of 1031 exchanges for our investors, selling their property and then rolling the deferred gains into an investment with us. So if that's something of interest, I highly encourage you to talk to Dasha before she blows up and becomes famous when she publishes her book about 1031 exchanges. And then finally, we're very excited to unveil our referral program. And this is we couldn't think of a better place to share this new program than with our best investors in our favorite place, our roots in Silicon Valley, because we want to reward all of the investors that have been giving us referrals, that have been helping us grow, and we want to encourage you guys to share us with like-minded people, right? Some of you are our favorite investors, and we want more people just like you. So with that, we want to extend our gratitude and reward those by offering a $2,000 referral for any investor. It doesn't matter if they invest $50,000 or $500,000. We are willing to share a $2,000 investor referral for any LP. This is a typo. For 1031 exchanges, if you have a rich friend that has a property that isn't providing them good cash flow and they want to sell it but they've been stubborn, convince them to sell it and 1031 exchange with us, and we will give you not a $5,000 referral fee, but a $10,000 referral fee. Okay, I think that pretty much shares it. So thank you everyone for your time. This guy?
Questions?
Yeah, Corlin, this guy. Yeah. Okay, we have a question from the audience.
Hey, more questions, yeah.
More questions. So we have a question about our deal that's closing on Friday. Tell us the 3 things that you like about Corlin, this guy. So it's almost like I planted this question that you like, you know, I gave you $20 to ask me this question. So I'd love to talk about this deal. So Portland Biscaya is a 312 unit deal. You could actually even pull up the picture of it. So it's a beautiful deal in West Houston. It's actually located in the Katy ISD. So Katy School District is the #1 school district in Houston. A lot of people move to this area solely for the schools. And this is as you can see, a sprawling 2004 vintage property, very well manicured grounds. And we are partnering with the Houston Housing Authority on this to receive a 90% property tax exemption on this deal, which is really the crux of the business plan. You know, we aren't going to be spending millions of dollars on renovating the interiors and everything like that, which, you know, it's not bad, but it's a different profile. It's more risky. And so we like the low risk approach of getting the tax exemption the day we close, which is hopefully Friday, and able to generate outsized cash on cash returns because of the day one tax exemption. So I definitely think the unique tax exemption program, the location with the quality school district, and then also it's never a bad thing where you're able to negotiate $1.5 million off the price, you know, to get the price a little lower. So I think the basis is fantastic, location is fantastic, and the business plan is very unique. We have another question in the back.
How much are you saving in tax?
Ooh, Brad,
I can give you that one.
how much are we saving in tax?
It's going in property tax is about $1,600,000 or $1,060K, and property tax is about $145 for the entire property.
So we're basically abating $1 million in property taxes.
Recurring, and that's also,
And that's a 99-year exemption.
yeah, that's transferable to the next person, of course, which is the value creator of this opportunity.
Do you have to prove anything to keep this exemption?
So the approval is one time. You don't have to get an annual recertification or anything like that, but we do have to maintain compliance audits, which we have a lot of familiarity with and a lot of rapport with the Houston Housing Authority. So it's something that we know how to work around, and we underwrite it going in. So we are properly accounting for the reduced rents, the reduced revenue in our projections, along with the reduced expenses, of course. Any other questions?
Well, when you move into the Phoenix area, is it also the same type of strategy, looking at affordability?
Yeah, that's a really good question. So we've gotten a lot of questions about when are you going to expand into a new market, but at the same time, a lot of people are asking, oh, well, why Phoenix now that we're sharing this ambition? And Phoenix actually has very low property taxes. Phoenix has very low insurance costs. So Phoenix has a very different deal profile than Texas. In Texas, you've got high property taxes, you have high insurance rates. So the expense risks are much more substantial than you have in Phoenix. However, in Phoenix, while you don't have the expense risks, which we like that, it's a diversifier, right? We're getting a different type of exposure in Phoenix as opposed to Dallas or Houston. Phoenix, of course, has its own share of risks, which are predominantly on the revenue side of things, because it's been historically known as a bit more of a boom-bust market, which I think it's growing out of that. And it also has experienced a lot more supply, some of the most supply in the country. It's like Phoenix and Austin are the two pinnacles of oversupply right now. So they have, Austin, no market is perfect, but we really do like actually the differences rather than the similarities of the markets. They're both high-flying growth markets, as you saw in the chart, some of the top markets in the country, but the risk profiles are different, and we'd rather diversify our risks there.
So how do you offset the risks on the revenue side? How are you looking into that?
Well, it's kind of like your classic Lone Star thesis, where we seek to buy in the Goldilocks locations, where we're not in Maine, in the hottest part of town, where there's a lot of developer interest, but we're also not in a bad location where actually population growth is decreasing. So we want to be in that sweet middle where it's like affordable, attainable housing in the suburbs where things are kind of trading below replacement costs, so we're somewhat insulated to new supply. There's no perfect answer, right? You're always susceptible to oversupply risk, but that's been the Lone Star thesis.
Not to belabor the tax exemption subject, but what's the affordability level you require as a percentage of AMI? Is it mixed across a few? And as a follow-up question, what kind of projecting as far as AMI growth
Yeah, that's a fantastic question. So more, it's a more advanced question regarding the income and rent restrictions related to the property tax exemption program. So with these deals, you have to restrict a portion of the units. Typically speaking, you're looking at restricting 30% of the units at 80% of area median income and 20% of the units at 60% of area median income. The types of deals, I know there's a lot of numbers. The types of deals that we pursue, the rents are already naturally occurring affordable to the point where there's not much of a hit to the rents when we restrict them down to the 80% thresholds. Now when we have to bring them down to the 60% of area median income thresholds, that's where we see $200, $300, $800 drops in rent, especially when we talk about the 3 bedrooms. And so those are meaningful drops. But of course, those all factored into our analysis so that the net, it obviously has to make sense to us. And then as far as the AMI growth, so HUD posts those AMIs every year, and over the last 10 plus years, Houston has seen over 3% in annual AMI growth, which is nice because it's like almost a built-in annual rent growth into your deal, because you've got, let's say a 2-bedroom would normally rent for $2,000 and you have to restrict it to $1,300. Well, when the AMI restriction or AMI threshold goes up by 3%, you're pretty much able to lock in that 3% bump on $1,300 because you're still so far away from market rent. So we really like that idea, and also, of course, we really like the stability associated with having locked in reduced property tax, given how volatile property tax is going to be in Texas. Good question.
Don't you experience higher costs from the tenants? They are harder on the property, these restricted housing?
Yeah, I think that is generally true. But like I said, a lot of the properties that we target for this program are already in that naturally occurring threshold. So it's not like we're seeking substantially different tenants. A lot of these tenants are already fairly similar. But yeah, I don't disagree that a tenant that you're bringing in at a much lower income bracket is harder on the property and can thus cause higher turnover costs. However, the goal is that we can lock these tenants in and they can stay on the property for longer to offset. So you have a higher renewal rate, but of course higher turnover costs. But in the end, I would take that trade. All right, I think we'll do one more.
Can you talk about some of the lower performing properties, like Referral, right, or what's happening over there? How are things going?
Sure. Yeah, so the question was to talk about some of our poor performing properties in the portfolio. So we have a couple of deals, and I don't know if you want to pull up the chart, or it's okay. So basically, we talked a lot about supply. And so this is a narrative around the country, and unfortunately, a lot of the deals we own, and Houston is not immune to some of these oversupply challenges. So in pockets where we saw rent growth growing 5%, 10%, even 15% per year, we saw those trends reverse and go into the opposite direction. And we've seen rents go down by $100, $200 or more, as well as concessions are in the market where our competition across the street is offering the first month free and discounting their app and admin and things like that, which make it very difficult for us to stay competitive with the properties in our comp set, as well as try to maintain screening for high quality tenants, right? Because it's kind of it's a double-edged sword, where if you're willing to discount to try to compete with the market, then you might be attracting lower quality tenants. So it's a very big challenge to try to maintain high occupancy, maintain high quality of tenants, and keep your rents up. So we've seen revenue in many cases come down because of this oversupply issue and buying at a generally high time in the market when the anticipation was for rents to continue to go up, and unfortunately they went in the opposite direction. Fortunately for us, we have, for the most part, very stable situations where those deals may not be performing at 95% occupancy today, but they have property tax exemptions through the affordable housing program, which helps to offset the loss of revenue from projection. So the idea is we have long-term fixed rate debt, we have reduced property taxes. So in the end, those properties will be worth more when there's a market for them, and we'll be able to still earn a solid return in spite of having poor timing on the acquisition, because unfortunately, many of the deals purchased in 2021 and 2022 are really challenged by not just the fundamentals softening, but also the prices that were paid for those deals and the financing that was put on those deals. So, like I said, we were able to correct a lot of those issues through the property tax exemptions, but we're still working through the supply glut and trying to get those properties back performing up to pro forma in due time. That's a good question. All right, I said it was the last question, but if there's one more, we can do one more.
What do you think of the deal flow for next year? Is that gonna be like a lot more because of the lots of debts on due? How do you feel about that?
Yeah, the question is, what are our expectations about deal flow in 2025? Because there is kind of this pent-up demand. A lot of people wanted to sell this year, a lot of people wanted to buy this year, and a lot of people didn't get to do those things for one reason or another. Maybe the price wasn't there or interest rates weren't there. So I do think there's a lot of pent-up demand and people are going to want to hit the go button and transact more in 2025. So I'm almost positive that there'll be more transaction volume in 2025 than 2024. But other than that, we're going to really stay focused on our niche of property tax exemptions and then finding good value on purchases outside of that strategy as well. Yeah.
You know, because all of this is based on the tax exemption with the new Trump administration and with the goal to try to make it more affordable. Do you see anything in the law that will affecting this market at all?
Yeah, so the question is about political risk to the affordable housing structures, and I think there's a lot of it. It's a Texas-specific program, and so there is talk about those laws changing in Texas, which would alter the way that we do these deals or abolish them completely. And we're keeping a close eye on that, and obviously if it goes away, then it goes away, and our deals will be grandfathered in, but we won't be able to do new deals, which would obviously be a shame. So there's not really anything we can do about that, but we do feel like, I mean, as long as it's still open for business, we will continue to do it. And we think that in 2022, they did amend the laws, but we were still able to find ways to still make those deals work. So we're optimistic that the laws will probably change in 2025, but we'll still be able to find ways to make those deals work. All right, last question, I promise.
How many projects have you finished the cycle, especially for the affordability housing?
Yeah, it's a good question. So we've had 2 deals that we've gone full cycle on. We acquired them in 2018 and 2019 respectively, and then we sold them in 2021 and 2022 respectively for an average hold period of about 3 years. Those deals went very well for us for a handful of reasons, not the least of which the timing. Obviously buying in 2018, 2019 was a great time, and then exiting in 21, 22 was great timing as well. We saw rent growth, cap rate compression, and we also were successful in our business plans as far as hitting the rents that we set out to hit, the renovations, the occupancy targets, the crime mitigation, and so on. So those were our 2 successful exits, but both of those deals were value adds and they were not affordable housing tax exemption plays. So the reality about these structures is they're very new in Texas, and so only a handful of them have actually gone full cycle and traded. So we believe that it's going to take a while for the market to understand these deals, learn them, and get comfortable with them. So that way, when we go to sell, we want to be the guinea pig and be the first one to sell our deals because we know that we're not going to get the top price. So we want to wait for the market to learn these deals, have a couple actually go through with sales, and then once people come to realize how exciting and unique these deals are to own because of the locked-in lower property taxes, we think that it'll be an opportune time to exit those deals in probably 2027 at the earliest. Okay, like I promised, that is my last question. Thank you so much for the great questions. We're here for another while, so please enjoy yourselves, have some drink, have some food, and let's continue to chat. So happy holidays, everybody. Thank you for coming.